Stop guessing, stop hoping, and stop listening to people who tell you that saving $1 million is enough. It is not. Today, let's talk about the exact dollar amount you need to never work another day in your life. If you want $3,000, $5,000, or even $10,000 a month in pure, passive income from the most popular dividend ETF in the world, the math is simpler than you think, but the price tag is going to shock you. This isn't about getting rich quick. It's about the cold, hard numbers of financial freedom. Most people think they can retire on a standard nest egg. Today, I'm going to show you why that might be a trap, why inflation is eating your future alive, and exactly how much capital you need to generate a paycheck that lasts forever using just one ticker symbol. I am not a financial advisor, and everything we discuss today is for entertainment and educational purposes only. Please do your own research before investing your hard-earned money. I am Tony, and this is Grow with Tony, where we strip away the hype and focus on making your money work harder than you do. Today we are doing the ultimate deep dive into the beast of dividend investing, SCHD, the Schwab US Dividend Equity ETF. You see it in every YouTube thumbnail. You hear about it on Reddit. It has a cult following. But very few people actually understand the mechanics under the hood. They just buy it and hope for the best. Hope is not a strategy. Math is a strategy. We are going to go long today. We are going to cover everything. The methodology, the tax implications, the compounding snowball, the risks, and the exact roadmap to replacing your salary. So first, let's open the black box. What are you actually buying? When you buy a share of SCHD, you aren't just buying a random basket of stocks that pay a dividend. You are buying a highly engineered machine. This ETF tracks the Dow Jones US Dividend 100 Index. Now, why does that specific index matter? Most dividend funds are lazy. They just look for the highest yield. They buy companies paying 6, 7, or 8%. That sounds great on paper, but in the real world, a company paying 8% is usually a company in trouble. The stock price is crashing, so the yield looks high. That is called a yield trap. You buy it for the income, and then the company cuts the dividend and the stock tanks. You lose twice. SCHD is different. It is aggressive about quality. It starts by looking for companies that have paid dividends for at least 10 consecutive years. That filters out the new, unproven companies. But then, and this is the secret sauce, it ranks them based on 4 fundamental metrics. Metric 1, cash flow to total debt. Can the company actually pay its bills? Metric 2, return on equity. Is the management team good at using shareholder money to generate profit? Metric 3, dividend yield. It does want yield, but it balances it with quality. And metric 4, the 5-year dividend growth rate. This is the most important one. We don't just want a dividend today. We want a raise next year and the year after that. Every March, the fund reconstitutes. This is like a sports team cutting the players who are getting old and slow and drafting new superstars. If a company stops performing, SCHD kicks it out and replaces it. You don't have to do anything. The fund does the dirty work for you. The expense ratio for all this management, 0.06%. For every $10,000 you invest, Schwab takes $6 a year. That is basically free. Historically, the yield hovers around the 3.4 to 3.6% mark. For our math today, to keep things realistic and conservative, we are going to use a 3.5% dividend yield. So let's get into the numbers. This is why you clicked on this video. This is the part where dreams meet reality. I have broken this down into 4 levels of financial freedom. Level 1, the sleep well at night number. Let's say you don't want to retire yet. You just want a safety net. You want $1,000 a month. That is $12,000 a year. This covers your groceries. It covers your car payment. It means if you get laid off, you aren't starving. To get $12,000 a year in dividends at a 3.5% yield, you take $12,000 and divide it by 0.035. The number is roughly $343,000. 343 grand. Now some of you are hearing that and thinking, Tony, that's a lot of money just for $1,000. And you're right, it is, but remember you aren't selling the shares. That is cash flow generated without touching your principal balance. You still own the $340,000 in stock, and if the market crashes, you still get paid. If the market booms, you still get paid. That is the psychological power of dividends. Level 2, the lean fire number. You want to quit your job, you are willing to live frugally. You want $3,000 a month. That is $36,000 a year. This covers a modest mortgage, utilities, food, and basic living expenses for a single person or a lean couple in a low-cost area. So take $36,000 and divide by 0.035. You need $1,028,000. We just crossed the 7-figure mark. Over $1 million to generate a $36,000 salary. This is the reality check most people ignore. If you're starting from zero today and you invest $500 a month, it will take you decades to hit that $1 million mark purely through savings. You need the market to do the heavy lifting for you. You need to focus on increasing your income so you can shovel more money into the machine. Level 3, the middle class freedom number. This is where most families want to be, $5,000 a month, $60,000 a year. This is a respectable salary. You can raise a kid, you can go on a vacation once a year. You are truly independent. The math, 60,000 divided by 0.035. $1.7 million. At this level, you are essentially a small business owner. Your business is your portfolio and its only product is cash. Level 4, the Fat Fire. You want $10,000 a month, $120,000 a year. You want to travel internationally. You want to drive a luxury car. You want to pay for your kids' college in cash. You don't look at the price tag on a menu. 120,000 divided by 0.035. $3.4 million. Now, before you click off because 3 million sounds impossible or even 1 million sounds impossible, I need to introduce you to the concept that changes everything. If you stop listening now, you miss the entire point of dividend investing. The concept is yield on cost. See, if you buy a rental property for $100,000 and you rent it out for $500 a month, your yield is based on that original price. But unlike a rental property where rent increases can be slow and you have to fix toilets, SCHD companies increase their payouts aggressively. Historically, SCHD has grown its dividend payment by double digits annually on average over the last decade. Let's be conservative. Let's say it grows at 8% a year. Here is what happens. You buy a share today for $80. It pays you roughly $2.80 a year. That is a 3.5% yield. But 5 years from now, that dividend payment has grown. 10 years from now, it has doubled. If you hold that same share for 20 years and the company keeps raising the dividend, you might be getting paid $10 or $12 a year on that single share you bought for $80. Your yield on cost is no longer 3.5%. It is 10%. It is 15%. Warren Buffett buys Coca-Cola. He bought it 30 years ago. Today, Coca-Cola pays him a dividend every year that is more than 50% of his original investment. Think about that. Every 2 years, he gets his entire money back in cash and he still owns the stock. That is the game we are playing with SCHD. We aren't trading. We are accumulating income streams that grow faster than inflation. Speaking of inflation, this is the silent killer. If you keep your money in a high-yield savings account or bonds, you are getting a fixed rate. If inflation spikes to 5 or 6%, your purchasing power drops. SCHD is an inflation hedge. Why? Because the companies in the fund, Home Depot, Pepsi, Chevron, have pricing power. When inflation goes up, Pepsi raises the price of soda. Chevron raises the price of gas. Their profits go up and then they raise your dividend. Your income keeps up with the cost of living. A bond cannot do that. Now let's talk about taxes. This is a boring topic that will make you rich. Dividends from SCHD are generally considered qualified dividends in the United States. This is a massive deal. Ordinary income, like the money you make from your job or interest from a savings account, is taxed at your highest bracket. That could be 24, 32, or 37%. Qualified dividends are taxed at a lower rate. For most people, that rate is 15%. For some low earners, it is 0%. So let's go back to our level 3 scenario. You are making $60,000 a year from dividends. If that was salary, you'd pay standard income tax, but because it is qualified dividends, you might pay significantly less tax, meaning you actually keep more of that money in your pocket. It is one of the few tax loopholes available to the average person. But I would be a terrible financial friend if I just sold you the dream. We have to talk about the risks. We have to talk about why people hate on SCHD. Risk number 1, the growth drag. SCHD holds value stocks. It does not hold the Magnificent Seven. It barely has any exposure to Apple, Microsoft, Amazon, or Nvidia. In a year like 2023 or 2024, where AI stocks went to the moon, SCHD looked boring. It might have even been flat. You will suffer from FOMO, fear of missing out. You will see your friends making 40% in tech stocks while your SCHD portfolio is up 4%. You have to have the stomach to stick to the plan. You cannot panic sell and chase the hype. Risk number 2, concentration. 100 stocks is diversified, but it is not the total market. If the financial sector or the industrial sector takes a hit, SCHD will take a hit. During the banking crisis, financials dropped. SCHD has a good chunk of financials. You felt that pain. Risk number 3, total return. If you are 20 years old, should you be 100% in SCHD? Probably not. You have time on your side. You can afford the volatility of pure growth stocks. By focusing only on dividends too early, you might end up with a smaller portfolio value at age 60, even if your cash flow is good. So how do we fix this? How do we build the perfect portfolio? Most smart investors do not go 100% SCHD, they pair it. A popular combination is the SCHD and chill strategy, but modified. You put 50% in SCHD for the stability and income growth. You put 50% in something like QQQ or VGT for pure tech growth. Or you pair SCHD with VOO, the S&P 500. This gives you the best of both worlds. You get the explosive growth of tech during bull markets, and you get the defensive, cash-flowing stability of SCHD during bear markets. Let's simulate a crash. Let's say the market drops 30% tomorrow. If you own speculative tech stocks, they might drop 50 or 60%. SCHD companies are boring. They make toilet paper, soda, semiconductors, and gas. People still buy these things in a recession. SCHD might drop, sure, but historically it drops less than the broader market. And here is the best part: while the market is down, SCHD is still paying you that dividend. If you reinvest that dividend while the market is down, you are buying more shares at a discount. You are supercharging your snowball. This is why dividend investors secretly love bear markets. It's a sale on future income. So let's wrap this up with the final verdict in your action plan. Is SCHD the perfect ETF? No, there is no such thing as perfect. But is it the best tool for building a reliable, inflation-protected income stream that can eventually replace your job? In my opinion, yes, it is the gold standard. But you have to be realistic. To get $1,000 a month, you need $343,000 invested. To replace a middle-class salary, you need $1 million. To live like a king, you need $3 million. The numbers are big, but the journey starts with the first share. It starts with buying one share for $80 instead of going out to dinner. Then you let the dividend buy a fraction of a share. Then you add more. Then the snowball starts rolling. Financial freedom is not magic. It is not luck. It is math plus patience. The math is simple. The patience is what weeds people out. Most people will quit after 2 years. The winners are the ones who are still buying in year 10, year 15, and year 20. I want to know where you are on this journey. Are you just starting level 1? Or are you closing in on that $1 million level 2? Let me know your number in the comments below. And tell me, what other ETFs do you want me to break down? Do you want to see a battle between SCHD and JEPQ? Or maybe a deep dive into VOO? Leave a comment, tell me what you want, and I will make that video for you. But if you don't comment, that's cool too, just keep grinding. If you found value in this deep dive, do me a favor. Smash that like button. It actually helps the algorithm show this to more people who need to hear the truth about money. Hit the subscribe button and ring the bell so you don't miss the next class. I'm Tony, this is Grow with Tony. Stay disciplined, trust the math, and I'll see you in the next one.